Good afternoon and welcome to NYFP. In midday trade, we are seeing the major U.S. stock averages remain in negative territory. Joining me today to weigh in on the market action is Meyers of DME Securities. Warren, good afternoon. Thanks for joining me today.
My pleasure. Glad to be here.
Well, we are seeing the equity averages in the red. We have to keep in mind that we're seeing light trading conditions and we don't have too much economic data stateside. But yesterday we saw stocks reverse earlier losses following Fed comments. We still have Fed comments this afternoon. So how do you think we'll close today?
Unfortunately, it feels like the market's a little bit tired, and the trend has switched from an upward momentum that we'd seen for many a month into a kind of a tired market where the momentum seems to have stopped going up, and if not necessarily a heavy down momentum, at least it's a stalling kind of feel. So it's got the sense that we're down now. We'll probably stay down on the day. You know, there's a lot of anxiety about exactly what the Fed is going to do and when, and I think that's just weighing on a market that's moved up considerably, and you know, gives everyone a little bit of trepidation on jumping in and buying into the market until they get a little more clarification.
And Warren, I think it does all weigh on the Fed. That's why we're seeing so much gyration in the market whenever there's a speaker out from any of the Federal Reserve banks. But given that we still have another jobs report before the next Fed meeting on September 17th through 18th, what do you expect to see for the equity markets between now and then?
Unfortunately, you're probably going to see quite a bit of what we've been seeing over the last week. A tired market that maybe will drift a little bit lower with a few up days based on whatever economic data maybe could push it up on any given day. I think that last jobs number will be pretty important. I think the Fed probably has not made up its mind completely that if they're going to start to tighten on the September meeting or not. I think they're certainly leaning that way. If a jobs number comes in, though, that it's extremely being a weak surprise, a very weak surprise report, that may push it off for another month or so. So I think, you know, given all that anxiety and the importance of that last jobs number, I think people are going to be very careful about jumping into this market. And again, that's one of the reasons you're seeing light volume, and that's one of the reasons I think you've seen the market drift a little bit lower over the last few days.
And Warren, bigger picture, there has been some talk about a possible market crash, but that's not surprising given that we saw record highs prior to last week, and then we closed lower for the week and the previous week. So what do you make of that chatter?
I think basically it's, I'll put it this way, I think it's sour grapes. I think it's a lot of people that missed getting into this market at the beginning of this long extended rally are maybe encouraging that kind of activity so that they'll give it an opportunity to get back in. Beyond that, I think the likelihood of something like that is very limited at the moment. I mean, it's going to take a lot for a massive correction to actually hit this marketplace. But again, I think it's people that missed the boat that are looking for an opportunity to get in on a cheaper environment. And they haven't been given many opportunities to do that so far.
And Warren, you do bring up an important point considering that the equity averages are higher for this year and we still have a couple months left for this year. But given that earnings season is winding down, were there any surprises for you?
I think the earnings came in about as expected. I mean, I don't know what the final tally is. I'm guessing the upper 60% on meat, or I mean rather on beats, on at least on the earnings front. Revenues were a little worse than that, and that's been typical of what we've seen over the last couple of months. You know, lowered expectations, lower numbers across the board, but again, not terrible, not great. So I didn't see too many surprises on that front. I think we've seen some inflation numbers coming out this morning. We had some that show very limited in inflation, and that's a key that the Fed's looking at. So no, I think everything's been pretty much status quo. You know, we're in that long drought now between August into the maybe middle of September, where we finish earnings season. The data is going to be key. A lot of people are taking time off. The volumes are lower, and this is usually the time, if there's ever going to be any kind of minimum pullback, you might see it during this period of time. So I think that's par for the course, and what we've seen on the little bit of a sell-off we've seen in the last few days, last 4 or 5 out of 5 sessions, is nothing unexpected.
And indeed, it is quiet here in the U.S., but it'll also continue to be quiet on the other side of the Atlantic. But we did get some preliminary second quarter GDP figures, and some of that data was not surprising, especially when you look at the growth figures for nations such as Germany or France compared to the PIGS nations. But in terms of the growth outlook for the entire world, have you changed your outlook?
No, I mean, I still think the wild card's probably China. It's hard to get a sense of how accurate all that information, all the data is out of there. And everyone was expecting those numbers to pull in a bit, and they did, but nothing terrible. I think one thing that's being overlooked or not talked about as much today is the fact that the Eurozone seems to has pulled out of that recession, and I think that should be something that we should be celebrating, the fact that it was a struggle for them like it was here in the United States a few years ago, and the fact that they've appeared to have righted the ship and get things going in the right direction. I think that's cause for a little bit of celebration. I think it's dampened here in the United States because we've kind of topped out in this recent market, and we're a little bit tired here. So I think it's a shame. I think that's very positive news. Overall, my expectations, I think you're going to see, much like you've seen here in the last year, very moderate growth worldwide. Certain regions obviously will be doing a little bit better than others, but I think I'm not looking for any zone to go into a recession necessarily, but I think it's going to be very moderate growth probably for next year.
And Warren, last but not least, before I let you go, we've covered fundamentals across the globe. So in terms of your technical outlook, I know you keep an eye on the S&P futures. So what levels are you watching?
Well, right now, let's see where they're at 1685. I mean, tight range, I would say 1683 might be a little support on the bottom, and 1691, again, fairly tight on the way up. I think the bigger picture, though, is 1675 and 1695 to 1700 range. We've had a struggle once we got up that high the first time around. I would like to see if we get back up there, if we can punch through. I'm not expecting that to happen, though, in the next few days. That's down the road a bit. The key, though, is those support levels. If we can hold those support levels and build a little base during this quiet time, I think that would be a very positive going forward into, in particular, getting into September.